Welcome to Prekani Trading Networks. And once again, you're welcome to Forex 102 Beginner's Course. Take your time, learn the skill that will pay you for the rest of your life. In order to get started, you need to have one thing in mind. I am a student, always. Do not compare yourself with anyone else's progress. Always keep a winning mind frame, and you will do very well in this business. Upon finishing this lesson, you should know the answers to the following questions: Forex market hierarchy, different ways of trading Forex, Forex versus stocks, difference between Forex and gambling. So we're going to be talking about the Forex market hierarchy, where we have the interbank. They set the pace for the market and determines the exchange rate. We have large commercial companies. Companies do business internationally on a constant basis. They exchange those currencies back and forth and typically are relevant in the market on a day-to-day basis. We have the government, we have the central banks, we have spot market, which comprises of both retail traders and speculators. Now let's talk about the ways of trading Forex. There are 4 different ways of trading Forex. 1. Spot market or spot trading. Here, currencies are traded immediately on the spot using current market price. What's awesome about this market is its simplicity, liquidity, tight spread, and round-the-clock operations. Then we have the futures. Here you have the contract to buy or sell a certain asset at a specific price. Now, when you hear the word assets, alright, in this context of Forex trading, we're talking about currencies, we're also talking about, index funds, we're talking about, in fact, let me just put it in general, we're talking about financial transactions, okay? So when you hear the word contract, when you hear the word assets, we're talking about financial transactions, okay? So here are contracts to buy or sell a certain asset at a specific price on a future date. Futures contracts are traded through a centralized exchange and is well regulated. Alright. Then we have options. An option is a financial instrument that gives the buyer the right or the option, but not the obligation, to buy or sell an asset at a specified price on the option's expiration date. If a trader sold an option, then he or she will be obliged to buy or sell an asset at a specified price at the expiration date. Just like futures, options are also traded on an exchange such as the Chicago Board Options Exchange, the International Securities Exchange, or the Philadelphia Stock Exchange. However, the disadvantage in trading Forex options is that market hours are limited for certain operations, and the liquidity is not nearly as great as the futures or spot market. And then finally here we talk about the exchange traded funds. This contains a set of stocks combined with currencies, which allows the trader to diversify with different assets. Alright, so these are created by financial institutions and can be traded like stocks through an exchange like Forex options. The limitation in trading ETFs is that the market isn't open 24 hours. Also, since ETFs contain stocks, these are subject to trading commissions and other transaction costs. Now let's talk about Forex and stocks. Let's know the difference. Now let's talk about the stock exchange market. Stock exchange market is the largest market in the world. And the New York Stock Exchange market is actually the largest stock exchange market in the world, which trades a volume of about 22.4 billion each day. Stocks are from approximately 2,800 well-established and financially sound companies and generally have a low volatility. The stock market operates 8 hours a day, 5 days per week, and the New York Stock Exchange is located in New York City, United States. Here we have what we call the buy and hold investors. Alright, these are the investors that invest into the stock exchange market for long-term profits. Now let's talk about the Forex market. Forex is the largest financial market in the world. I repeat, the largest financial market in the world is the foreign exchange market, averaging a daily trading volume of approximately 7.2 trillion. The forex market is 200 times bigger than the New York Stock Exchange. Unlike every other market, the forex market has neither a physical location nor a central exchange. The scalp traders, swing traders, intraday traders, and position traders prominently prefer the forex because of the market volatility. It is much higher than the stock market. The forex market is very attractive because of its high liquidity. It's a 24 hours trading opportunity and the amount of leverage afforded to traders. Now you can see the difference from here. Alright, stock has to do with trading of what, or buying of shares, company shares, or trading of company stocks. Alright, whereas forex has to do with country's currency, the trading of currencies. Alright, and we can see the clear difference. So when you're coming into stocks trading, it means that you're going to have the idea or notion that stock trading involves long-term duration, which is between 1 to 10 years or more than that. Alright, and the forex market is a short-term investment. It can give you profit on daily basis, it can give you profit on weekly basis, and it can give you profit on monthly basis, unlike the stock exchange. Now there are three types of analysis. First, we have the technical analysis. Here, traders study price movements to determine the direction of the current trading conditions. Alright, we have the fundamental analysis. Here, traders analyze social, economic, and political impact when looking at forex markets to determine what the direction of the current trading conditions. And finally, we have the sentimental analysis. Here, traders take a view of attitude or overall traders' attitude towards market analysis. Thoughts and opinions help create the overall sentiment of the market. This is based on perception combined with all other types of analysis to see how the market is feeling. We as traders will decide how to incorporate market sentiment and the trading strategy. So now, you as a trader, you need to consider these three analyses when carrying out your market analysis in order for you to have a better view of the market direction. Alright, you need to incorporate these three analyses together to have a stronger determination of where price will be going. Now let's talk about forex trading and gambling. Is forex trading gambling? Especially for religious people, most of them feels that forex trading is gambling. So we're going to break that down in this video. Let's know the difference between forex trading and gambling. It's a common trope on social media and among screenwriters that the stock market is just gambling. That people who invest in the financial market are speculators who only get lucky on their trades. Yet traders will insist that what they are doing is investing and far from gambling. Part of the conflation between trading and gambling is to use somewhat loose definitions of the terms. This is especially easy among people who aren't very interested and therefore informed about the financial market. So let's work from some solid definitions to clear up some popular misunderstandings and outright myths. Now let's look at the definition of terms. What is gambling? Gambling is when you play a game of chance, hoping you will get a bigger return than what you put in. The key words there being game and hoping. Now let's take a look at investing. Of course, we know that forex trading are all investment channels, whether forex or stocks. Investing is when you buy financial instruments with the expectations of getting a profit. The key words in this case are buy and expectations. Gambling relies primarily on luck and Exploits, a known psychological quirk in humans where we are willing to give up what seems a small amount of value now in the hopes that we potentially get a large return in the future. In fact, this is the basis of the lottery. You buy a ticket for a couple of dollars in the hopes of making millions. More importantly, however, is that gambling is a game. It doesn't generate a product or service. So the total winnings are the sum of all the amount put in. It's a zero-sum game. For someone to make money in gambling, someone else has to lose. And all professional gambling is set up so that the house always wins. That's the reality. In other words, gambling implies the odds are stacked against you, and in the long term, you will always lose money gambling. Investment builds wealth. Investment relies on a careful and accurate predictions of the future as possible. This is why investors hate uncertainty and will generally prefer ventures that come as close to guaranteeing a profit over one that promise lots of money. Investors are acutely aware of risks and factor them in when considering an activity. Investments are not a game. They are part of the productive activities of the economy and are designed to build wealth. Companies issue stock to invest in expansion or buy and sell currencies to pay for goods and services. Investment is therefore decidedly not a zero-sum game. It is not only possible but rather preferable that everyone who participates comes out with a net profit. Smart, diligent and hard-working investors are virtually guaranteed to make money in long term. So you can see the clear difference. So now let us know those persons that are gamblers as forex traders. Now, I've been able to explain to you the difference between gamblers or gambling and trading. Now I want you to also understand that there are those who gamble as traders. Those are the people I want to call out right now on this video. Alright, so I want you to pay attention so that in your trading career, you're going to know if you are going to be a gambler or a trader. Alright? In Forex, you can have both investors and gamblers. There are people who get in the market without a clear strategy, hoping to lock out and make money. Those are gamblers, and they typically don't make money in the long term. Investors, on the other hand, are the ones who understand the underlying mechanism or mechanics of currencies. They have a clear strategy, they are informed, and they always try to minimize their risks as much as possible through prudent money management. And typically, they are the ones who end up being profitable in the long term. So you can see the clear difference here. Those persons who are gamblers in forex trading, they trade without risk management. They open lots of positions at once. They expose themselves to a lot of risk. They have no plan or strategy. They trade based on emotion. And they are not disciplined. Alright? They are not disciplined at all. So those persons who are professional forex traders, they consider and they have sound risk management before entering a trade. They have a concrete trading plan. They focus on one strategy. They don't trade on emotion because they always have their risk factor before entering a trade. They treat trading like a real business, and they always learn from their mistakes through backtesting and journaling. So from this video, you can now see the difference. You know the difference between a professional forex trader and a forex gambler. Congratulations, you have come to the end of Forex 102. Please ensure that you ask questions in line with the context when necessary, as I am saddled with the responsibility to answer you immediately. Remember, never to compare yourself with someone else's progress. Take your time and you will understand better. Congratulations. See you on the next video.